This week sees plenty to sink our teeth into. Coming hot off the heels of Friday's jobs report, we see the US in focus once again with the latest US CPI inflation report alongside Chinese CPI, Chinese trade data, and an interest rate decision from the ECB. As ever, we'll kick off by looking at the top tier items according to the Trading Economics economic calendar. And things start on Monday with the Chinese trade data coming out, both imports and exports. This really highlights the benefit of looking at the Trading Economics calendar rather than many of the others. We get a little bit more granular detail. So as we can see here, the expectation this time around is that we're going to see a decline in terms of exports, but an increase in terms of imports. Then we see trade data out of Germany as well on Monday. And then Tuesday, Australian economy comes into focus with the consumer confidence figure and the business confidence figure coming out. And then back to China, inflation rate on Wednesday, overnight, Tuesday into Wednesday. Then the US PPI inflation report, kickstarting a period where inflation takes center stage, because on Thursday we've got the CPI inflation report alongside the ECB interest rate decision from the ECB for the Eurozone, and wrapping things up on Friday with the latest GDP figure out of the UK and the University of Michigan Consumer Sentiment Survey alongside inflation expectations. So we'll kickstart with the US. We start things off with inflation expectations. We wrap things up with inflation expectations. And in the middle of it, we've got inflation. That's PPI on Wednesday and CPI on Thursday. Of course, more recently, we've seen the core PCE price index report, and it has shown inflation to be under control still. 0.3 was the monthly figure, and we can see by and large markets expecting that core figure for 0.3 once again here. It stands to reason that the core figures are generally higher than the headline numbers because we've seen much of the disinflation coming from energy prices. But the expectation of 0.3 across both headline and core inflation means that it's running a little bit higher than they would like, but by and large still in line with believing that inflation by and large is under control. So of course it's not a given that this is actually what we will see on the other side. But if we do see figures something like this, yes, we could see a move higher in terms of headline inflation, but by and large that will be a base effects thing rather than something that's indicative of a resurgence in terms of inflation pressures. Now, if we're looking at the breakdown in terms of inflation, as we can see here, 2.7 on the headline, 3.0.5 on the core. More recently, if you're looking at inflation on a month-on-month basis, ever since Donald Trump's come into power, we haven't really seen a major uptick. The 0.3 monthly figure seen last time around is the highest that we've seen thus far. And so, yes, inflation appears to be under control despite the tariffs as things stand, and markets are expecting a 0.3 across headline and core this time around. Now, a different way of looking at it is the 3-month annualized, sort of rolling annualized figure. So if you took the last 3 months and turn that into a year, that sort of pace of or that trajectory of the last 3 months, what does it look like on an annual basis? And you can see here core actually and headline CPI both below that run rate. So that means that over the course of this year in particular, there's a good chance that we're going to see inflation moving lower, and you can see exactly that because if you're looking back to 2024, we actually saw a sort of growth in terms of inflation rate peaking out in that January month. So there is a good chance that we do see things sort of drift gradually lower. But really it just comes down to whether we do see those inflation pressures start to build under tariffs or whether it literally doesn't end up taking a toll whatsoever, and in which case you have to question where those tariffs are being paid. If they're not being paid by the consumer, then they're being paid by either the importing company or the exporting company. If it's borne by the exporter, that's a best case scenario for the US. If it's borne by the importing company, then you're talking about the potential for weaker earnings, and that of course puts potentially downwards pressure in terms of earnings growth and thus valuations within the stock market. Now, in terms of markets pricing right now, you can see the expectation for a rate cut in September. It's pretty much nailed on, right? 96%. Beyond that, there is a coin flip essentially for the October meeting, 53% majority just about for a rate cut. And then December, we have a 42% chance that we see a third rate cut by the end of the year. In actual fact, with the fact that we've seen, I'm recording this before the Friday jobs report, coming off the back of the weak ADP payrolls figure, the JOLTS number, the Challenger number, all of them coming in worse than expected. There's some calling for a 50 basis point cut, but whether that happens remains to be seen. I think it's very unlikely as things stand. I don't necessarily think that there's a desperate need for it right now, but there's certainly a need to cut rates. They're relatively elevated, and the question mark here is whether inflation remains under control. So this is the last inflation gauge before we actually see the likes of the Federal Reserve actually step in and make their decision, essentially. Now, in terms of price action for the likes of, let me just get onto it. Let's get onto gold. I think gold's a really interesting one at the moment. And while some might think gold's not a US index or the US dollar, it's heavily correlated with what's happening in the US in particular. So what have we seen here? So this is, of course, the wider trajectory. We've seen this breakout from this symmetrical triangle we've talked about for a long time. What was a range, then ultimately narrowed into a triangle. We saw the breakout. We've broken up through all of these swing highs, and now we're hitting record highs. We have hit record highs on Wednesday, now pulling back a little bit here on Thursday. So the 4-hour chart shows you that as things stand, we've sort of seen a bit of a pullback. There's a chance that what we're seeing here is sort of pullback of that. Let's just get the, let's get into the deep retracements. There you go. So it's coming towards that 61.8, starting to rebound once again. Now, if I put the 2-year on, the 2-year yield is essentially telling me rates over the nearer term, which means that it's heavily influenced by the outlook from the Federal Reserve. Now, if I invert it, there should be a close correlation between the two. There you go. So this essentially is a good way of being able to look at whether the shift in terms of market expectations for interest rate cuts from the Federal Reserve are impacting gold. You can see by and large we have periods where it impacts it more and less, but certainly, appear to have moved a line there. Certainly there's periods where it's very closely correlated, and sometimes otherwise. Sometimes different themes come into play. Of course, gold, you're talking about different drivers of price action. But nonetheless, more recently, you can see that we are seeing this sort of rally towards the upside, the rally in gold, the pullback here, as we see a consolidation and retracement, then we see the push higher. So very similar. That essentially means if we're looking for additional rate cuts, which means low inflation data coming out, then that's likely to push the price of gold higher. Market's expecting 0.3% across core and headline. I think if we come in below 0.3 and arguably if we come in at 0.3, but certainly if we come in below that, that should provide another boost for gold. Otherwise, if we don't necessarily see anything that's a change from market expectations, let's say we did see 0.3, then there's a good chance that we would see very little in terms of price action around those rate expectations. They wouldn't necessarily shift. Does that mean that gold won't move? Not necessarily. There are different drivers behind gold at the moment. And monetary policy, sort of 2-year near-term yields are just one element of that. So in terms of in terms of the outlook for the Eurozone essentially has one big ticket item for the week, and that is the interest rate decision from the ECB. Now, markets do not expect them to move this time around. It comes despite the fact that inflation, by and large, is under control. But they have already done quite a lot. Cast your mind back to the previous slides. The Federal Reserve's over 4%. Well, as you can see here, the interest rates here, 2%, 2.15, 2.4. So the ECB's already taken a lot of action. They don't necessarily want to drive interest rates down to zero and leave themselves with zero ammunition when it comes to potentially needing it down the line. So the question mark here is more around where this easing process ends. And therefore, there's a possibility we're going to come into this meeting, not expecting a rate cut. Are we going to see something in terms of an indication of where this ends? And if it does, then it potentially draws a line under the easing process. You can see inflation here pretty much under control, 2% for Eurozone inflation. The monthly readings over the course of the past, say, 5 months, 4 months, 4 months, pretty much non-existent, right? I mean, it's averaging out at about 0.1. And so the annualized figures coming in very weak, in particular that 3-month annualized figure you can see below 2%. So we're currently on a trajectory that means that inflation isn't really going to be a problem. The question mark for the ECB is, how low do you go really? And in terms of market expectations for that, we can see there's very little by way of expectations of additional easing. And in actual fact, markets are pricing just a single cut as a 50% chance. So it's a coin toss on whether we see any cuts between now and sort of back end of 2026. Does that mean that that's what will happen? No, that doesn't. That means that markets at the moment, they're going to be more confident and more accurate around what's going to happen at the next meeting than they will in a year's time, right? Because a lot can change between now and then. And also the stance of the committee members can change. So look out for commentary that comes alongside this. Does it essentially signal that this is the end of the easing process? And in which case, when you're looking at relative valuations, let's say the ratio between the 2-year in the Eurozone and the 2-year in the UK, that will change over time depending on rate expectations. If the ECB draws a line under its easing process, then that side of the ratio essentially comes to a halt. And it still moves, but it won't be necessarily influenced by the same way, to the same degree, by monetary policy. But then you have the potential shift on the UK side of things once the UK is in a position to be easing rates in a way that arguably they would like to do so, certainly with the problem in terms of the rise of borrowing costs in the UK right now. And that leads us on to the chart for, here we go, for Euro Sterling. So if we just bring up Euro Sterling quickly, there we go. So we've been pulling back, right? But you can see here that we're sort of within this consolidation phase at the moment. Let's just sort of grab this and go onto a horizontal. So I'm trying to pick these lows here. So you can see here 0.86 essentially. It's around that zone of 0.86 that we've sort of held up a number of occasions. Now, more recently, we've been trying to regain ground once again, but pulling back a little bit. So for me, I think there's a good chance that we do at least continue this sort of consolidation phase. From a wider perspective, you can see here we are in this recovery phase. It's a pair that we've covered a lot over the years, talking about the potential, over the recent months, talking about the potential for a resurgence that's taking hold at the moment. And so, yes, we're pulling back at the moment. In my mind, I think it's going to be a short-term phenomenon and potentially setting up for another rebound here. So this zone here looks really interesting, 865, 8665, that kind of zone. And if we break towards the downside, we need to break the 8638, but also really the 86 level to start pointing towards a wider pullback coming into play. Like I said, if we want to sort of euro to yield, there we go, divided by GBO2Y. Put that on a new scale. Let's see how things are being trading relative to those relative rates. So you can see the ratio between the two sometimes coming into play, sometimes sort of fading out, but certainly there's a very clear correlation between them here. And certainly if we were to come into a period of time where the ECB essentially halts its easing, then the pressure's on the UK. Now remember, the UK's got elevated inflation rates, so that it might not necessarily mean that they're going to suddenly start pledging that they're going to see a huge amount of rate cuts. But those rate cuts are going to happen down the line. So whether we see that strengthening in terms of euro sterling now or down the line, really, it will essentially turn the focus away from the Eurozone and instead towards the likes of the pound in terms of completing the other side of this argument. And then finally, let's look at China. And China, of course, has been in the news with Putin and Kim Jong-un paying them a visit. And it's a relatively busy week ahead. You can see that we kickstart here with trade data on Monday. We've got the Standing Committee National People's Congress over the course of the week. And crucially, we've got that inflation data coming out on Wednesday. And notably, like I said earlier, we've got an expectation we're going to see weaker exports and higher imports. How much of that is related to the trade relationship, or the weakness in terms of the trade relationship with the US nowadays with the tariffs that are currently in play, but they could be worse. But I do think the inflation side of things is really going to be important. It's a key gauge in terms of understanding exactly what the economic activity is like within China right now, what the demand picture is like at the moment. Markets are expecting a drop down into minus 0.1 on the year-on-year figure, but by and large, that is a base effect issue, because you can see the previous figure of 0.4 and the expected figure of 0.3 actually is a decent number, essentially, if you want to see inflation getting going again. But nonetheless, I think if you see these kind of numbers, 0.1 on the headline year-on-year figure, that's the kind of thing that can grab the headlines and really show people that China still remains a bit of a problem, quite frankly. You can see here PPI well into negative territory, CPI essentially non-existent. And what does that mean in terms of demand? Well, one of the areas I thought would be particularly interesting to talk around here is demand for Brent Crude, because essentially you're looking here from a perspective of demand for oil and the activity of the second largest economy in the world. Yes, but at the same time, we have the OPEC meeting over the course of the weekend that's going to lead us into this, as it calls for additional production increases from OPEC. So we should see some volatility for oil prices from that regard anyway. So in terms of, let's just look first and foremost in terms of long-term trend. And clearly we're trading in a downward bearish pattern here. That gives us a sort of wider view of where we could go. So is this just us sort of rolling over into that next leg lower? Well, let's look at the daily time frame. You can see rally up into trendline resistance, drop, lower high, lower low. That points towards this current rally as being a likely retracement before the bears come back into play. Thus far, we've come not quite into the 61.8, but we might be over already, right? We can see here that we've already dropped below into this support level, finding some support here. But I think we could falter, given the fact that we've seen this sort of ABC style retracement into a relatively deep retracement. We've now come in and touched that low, so we're no longer creating higher lows. That for me is a warning sign. And even if we regain ground here, if we do come into this week and OPEC announce a big production increase and the CPI number out of China comes in weak, that could, in my mind, signal the possibility of this market rolling over once again. I hope that's been useful. Make sure to like and subscribe and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.